Welcome back to Everything Money. It's Paul, Seth, and Mo in our studio here in Ohio. The show started, Paul, you and I were having more of a sit-down Joe Rogan style podcast. We talked about life, investing, real estate. We had guests. We still will do this in the future. And then one day we were talking about stocks, and I asked you, what do you look at? And you said, well, I look at these 8 things. We came up with the word pillar.
By the way, I don't think I even said 8. I said I look at these things. And then I'm like, oh, so that's 8 things. Like, it wasn't even like I look at 8 things.
Very organic.
Because I naturally just looked at those things.
This has really led us into the promised land that is this show now. I mean, Paul, we never could ever fathom having 5,100 patrons. We 60x'd our growth with subscribers, and we welcome you in if you're seeing us for the first time. We are reinventing our 8 pillars a smidge. Why, Paul? We had 8 pillars. You've been hesitant on some. Some of them are sector-based, like profit margin. So we've reinvented a few of them, and I'm eager to hear what they are.
So the ones we're changing are 1, the PE, 2, the profit margin, and 3, total current assets over current liabilities. For the PE, we're changing it from a 1-year look to a 5-year look. Mm-hmm. For profit margin and total current assets over current liabilities, they're still important. But for me, there are 2 other metrics that matter a little bit more that we'll get into that I think can give you a better feel for a company and where they stand and whether you should proceed to even doing more research. The key here, guys, is I want you all to be ready to look at a company and say, okay, I should ignore this company, or these pillars tell me what I need to do next. Go do more due diligence. It's not before with profit margin and current assets and current liabilities, there was more about debt that I wanted to cover. And there was more ratios that I thought mattered more than profit margin. Even though those are both very important, there's still other metrics that matter a little bit more on whether you should take the next steps of doing more research or not, because that's what we're trying to get you to do here. We're trying to show you a process to say, hey, how do I start from a high level and then decide if I'm gonna go further? Because investing, there's 10,000 options out there on what stocks to buy. You need an efficient way to go through the crap and decide what deserves more of your time versus not. One of the biggest criticisms we get, Seth, is you didn't do your due diligence. Exactly. Our goal is not to do due diligence to start. Our goal is to look at the 8 pillars and decide if it's even worth the due diligence later based on where things stand right now.
Yeah, because in the end, Paul, some of the most famous investors, they can spot a deal in the first sentence. And if it takes too long to explain, like I said, I have these conversations about Bitcoin and Tesla with people. If it's taking too long, I'm just throwing my hands like, it's out. I'm out. For us, we might, if it's over our heads, we're out. And so we want this basic screener. So in this video, we're going to look at the 8 pillars that we have made infinitely famous, Paul. World famous.
Yep. Warren Buffett actually recently called me and said, your 8 pillars is more important than security analysis from 1934. Don't quote me on that, but I'm pretty sure
that happened.
He may have mentioned it in his 13F filing too.
Yes. Yeah. So we will use...
I can't confirm or deny any of these things, but... this is for entertainment purposes only.
By the way, this is not financial advice. Okay, well, let's get after the 8 pillars and look at a company we all love, Best Buy. You know, you and I combined, and Mo too, own about 45 Sonos speakers from Best Buy. Mm-hmm. Go ahead.
Yeah, and Sonos, by the way, is outrageously expensive. I regret buying Sonos.
Oh my God, it's so expensive.
Okay, so guys, I'm just going to actually skip to the 8 pillars section because what I want to do is explain each one of these pillars directly. So Best Buy is an all 8 pillar company. The first one is 5-year PE less than 22.5. Now keep in mind, guys, we still show the 1-year PE, but I'm trying to show more of a long-term trend. Okay, if I take the average of the last 5 years of earnings and divide it into the market cap, so it's market cap currently divided by the last 5 years of earnings, I want it to be under 22.5. We increased that from the 20 we looked at before because to me, if earnings are increasing and you're paying on a 5-year average 22.5 times or less, it's something to look at because as earnings increase, you should be willing to pay more for the company. So this is why I changed that. I want to look more long-term, okay? 5-year return on invested capital greater than 9%. So return on invested capital can be calculated in so many different ways. The nuts and bolts of it is how do they earn money? What return do they get on the money that's invested in the business through equity and through debt? Okay, so I take it as free cash flow. I take the 5 years average free cash flow and divide it by the most recent years average long-term liabilities and equity. If it's over 9%, check mark. The average in the market is about 9 or 10% on a 1-year basis. So I'm looking at a 5-year greater than 9%. Okay, Revenue growth, still keeping it. Did they have revenue growth for the last 5 years? That's all I care about. Did they grow over the last 5 years? Boom, check.
Pillar number 4.
Net income growth, 5 years. Did they grow net income over the last 5 years? That's all I care about. Check. Shares outstanding. You guys know I love my shares outstanding.
And look at Best Buy, by the way, minus 21%.
Oh, yeah.
They're doing great.
This is the silent killer for companies, guys. Nobody pays attention to this, but it's very important that shares are going down, especially in cheaper companies. Are they rewarding their investors who are buying the company cheap by saying we're going to decrease the number of shares and therefore drive your share of the revenue and profit higher? Because remember, if a company has 10 shares outstanding, you own 1, you own 10% of the business. If they buy back 2 shares, now they have 8 shares outstanding, you still have 1 of those shares, but now instead of 10% of the business, you own 12.5% of the business. They've essentially rewarded you for staying on board and driving up your share of the profits and revenue.
This is new pillar number 6.
Now to pillar number 6. Guys, I wanted a metric that factored in their long-term liabilities. So I found a way to do it by saying, let's look at their average 5 years of free cash flow and how many years would it take for them to pay off all their long-term liabilities. So the calculation is very simple. Total long-term liabilities divided by the 5-year average free cash flow, we want it less than 5. Look at Best Buy's, 1.83. I will give a caveat. With retail locations, it's important to look at their capital leases versus operating leases. Capital leases are on the books, operating leases are not on the books. So it can be a little misleading on the retail front, but right now it's showing 1.83, which is less than 5. This means that if they just did their average free cash for the last 5 years for 1.8 more years, all their long-term liabilities would be gone. It's very difficult for companies to go under when they have good cash flow that can pay off low levels of debt. That's why a big reason why I added this one. Cash flow growth over the last 5 years, very simple. 1.8 billion, it's growing, that's all I care about. And the 5-year price to free cash flow, we want it the same as before. We want it to be less than 20. So these are the things we're looking at. This is how I changed the look of the pillars, but this gives you a much more accurate representation of where the company stands today in terms of its strength. Way more than just profit margin and current assets over current liabilities. But again, guys, I still want you to look at those because it does speak to other things. However, if you just want your high-level view of should I do more research, this one tells me definitely do more research, right? And you can get a pretty good idea going, man, they only have 1.8 times their 5-year free cash flow long-term debt. Dang, they really reinvest their money at really high rates of return. That's awesome. And oh my God, they're growing because their revenue growth is up there, but their 5-year average PE is only 19.4. Guys, it's hard to find a company even 19.4 on the 1-year PE. You're talking about 5-year average of less than 20. This is what we need to do. So I look for 22.5 or less. This is a great way to go forward, looking at your share, looking at your companies from a 500-foot view to say, should I do more due diligence?
If you've made it this far in the video, you should be congratulated because there are other very, very famous YouTubers like Stock Mo. They don't actually look at many of these numbers at all. They just look at analyst predictions and what they think the stock price. That's why they're every video, Paul, they're predicting some crazy, massive gain.
And I've never seen an analyst wrong about their predictions. Yeah, they're terrible. Guys, there's been so many things in the past that show analysts will alter their predictions and their buys. I never even look. I love it when people ask me like, "Hey, Paul, what do you think? How do you consider?" Somebody actually asked me, "Would you add analysts to the 8 pillars?" I'm like, "No, I don't care about analysts.
Yeah.
I couldn't care less about them."
So it does take some time to learn this. Mo, when you talk to normal people, how long can it take to fix this mindset of just looking at a ticker versus looking at fundamentals?
A normal person? I mean, this is years. I mean, what is it taking you 3 years?
Yeah, 3 years. Yeah.
It's hard to convince somebody that. I mean, I look at from a normal person's perspective. I look at $113.60 a share of Best Buy and I go, oh my God, that's expensive. It's over $100. That's super. I would never pay for something like that. I look at Amazon. I'm like, well, granted, they're different, but I look at $3,000 a share and I'm like, no chance. It's over.
Ever.
But it's hard for people to go and start looking at this stuff. I mean, we talk about shares outstanding. There's people that are in this world and don't even know what shares outstanding are. Nobody talks about it. So It's a long time. If you really want to do this, you have to learn and condition yourself to think a certain way. It's extremely possible. You just have to take the time to do it.
And I would encourage those who have wealth managers or financial planners, go to them and say, hey, what do you think about shares outstanding in a company? Like, can you explain that to me?
I'm telling you right now, if you are on the fence about your financial planner, just open up an email right now. I'll wait.
No, don't open up an email.
Go ahead. Just call them.
Go face to face because they can easily Google. Get them right in front of you and say, hey, question for you. How do shares outstanding affect the value of the company? See what they say.
Because you might very well know more than they do at this point. So if you study this stuff like I have.
And there's a lot of those financial managers. I mean, they'll just go out and they'll just talk about the PE, and that's all they'll talk about. And as we know, and as why we change this, because PE can be deceiving.
1-year PEs are very, very deceiving.
And that is why.
Oh, and then by the way, now they talk about, because the market's so expensive, forward PE.
Yeah.
Oh, but
Forward
next year's
PE.
earnings, it's only selling for 24 times. It's like, but that's still expensive.
That's why I was so adamant about changing that PE pillar, just because it can be deceiving, especially with a year like COVID. If you have anomalies like that, it changes things big time.
And by the way, this was Mo. I kept going back and forth. Mo finally looked at me and said, no, we need to change the 1-year PE to 5 years. And I was like, okay, you're right.
So if this resonates with you and if you feel alone out there in your investing process, as I've said on the show multiple times, that was me for almost a decade until I met Paul, is you can join our Patreon right now, have access to this software, all the tools we give you, a long-term retirement tool, stock analyzer tool. You can follow Mo on a day-to-day basis. He gives you videos on trading. We have so much we offer in our Patreon, and you can join right now, have access to software, and get your investment, your wealth knowledge churning, and be in the better. Paul, tell them about it.
So guys, mobile app, 8 pillars, 30 years of financial data, stock analyzer tool, daily content. We're going to be putting 1 or 2 videos a day just for the software users. Access to 3 of us, real estate calculator, stock screeners, retirement calculator, 5,000 plus and growing. We gain 50 people a day that join this Discord. Less than a cup of coffee, 84 cents a day versus $200 a month, $200 a month, and 35. You don't even get everything. This is a no-brainer, guys. Join us. This is awesome. Have fun.
Yeah, I don't know how you would make investing decisions by yourself without this. It was definitely difficult for me for a long time. I was just listening to a lot of dumb friends. So but that's our take. Thanks for following our channel. We just love you guys as patrons, and we're excited about our new 8 pillars, and hopefully they bring some more clarity to your investments moving forward. And we're happy to have you on the ride. We will see you next video as you fondle that thumbs up on the way out. See you, Paul.